Good afternoon, everyone. My name is Matt Gordillo. I'm a partner and financial advisor with ArcEdge Advisors. I'm joined by Gavin Gowicki, a portfolio manager, and Rich Lowry, our partner and chief investment officer. Hi, guys.
Hey,
Hey,
Matt.
Matt.
Let's pause for a moment from a word from our sponsor briefly. Okay, very good. Thanks for joining us again this month. And as we always start off, Gavin, maybe you could bring us up to speed from last month. I know Todd's been hosting these last few months, so I'm glad to be back. And why don't you fill us in with what's going on?
Sure. For April, the backdrop has begun to shift a bit from March. The conflict in Iran continues to be ongoing, although we've recently, gotten some ceasefire headlines. That conflict does continue to anchor the macro environment a bit, mostly due to energy. Oil remains elevated in terms of price. But really, market behavior broadly across asset classes has, even though that's happening, remained relatively measured in response. And initially we had a bit of a shock response to that. That's kind of died down a bit. And really, what we've seen from March is a shift into a quad two risk on condition for the market, which did coincide with a bunch of our signals, resolving towards quad two that were previously neutral. That happened around the ceasefire headlines. So at this point, nothing has changed too much in terms of still how long the duration of the conflict, remains present. How long the conflict takes to play out is important, and we'll continue to monitor the situation.
Yeah, and
Rich,
I would just add that, there's really no part of the investment process where we're acting based on headlines or tweets. It has everything to do with looking across all of global macro and seeing how are currencies behaving, how are commodities behaving, how are global bond yields behaving, how are credit spreads behaving, how's volatility behaving. If they all begin to change in a way that looks like a pretty consistent risk-off message across all these markets, we'll take action, and reduce risk. Obviously, that market behavior has been driven by headlines. We're going to war. We started to see risk-off signals. I think we spent 2 weeks in quad three, and the ceasefire wasn't so much the headline, but the fact that it changed the dollar, it changed volatility, it changed credit spreads. That was, our signal that, okay, we're back, to quad two. So, in hindsight, you can look back and say, well, that was a false signal, that was a head fake. And that kind of raises the trade-off between what are called type 1 errors and type 2 errors. A type 1 error is a false positive, that our signals pick up risk off, we act on it, only for those signals to revert back the other way. The trade-off in doing that is if you're willing to incur occasional type 1 errors, you can do a better job of avoiding type 2 errors, which are false negatives. So to give you an analogy, let's say you go to the doctor, you get a blood test, and it comes back and they say, Matt, bad news, you tested positive for XYZ condition. Later testing confirms that's a false positive. It does no real harm in the process other than it causes stress until you get the additional testing that disconfirm the condition. That's a much better outcome than a false negative. A false negative is we did the blood work and you tested negative for XYZ, but you really do have it. And that test was a false negative. That's much more dangerous, not just in health terms, but in market terms. A false negative is, no, we don't see any sign of risk off. You remain fully invested and then you get hammered with, a big decline. So it kind of goes hand in hand with active risk management in that the signals are not going to be perfect. We don't expect them to be perfect. We expect them to identify when the odds change in our favor and we act on it. The so-called price you pay for doing that is you get an occasional false positive that in hindsight looks like a head fake. But we would much rather have that than the false negative. And if you compare it to a buy and hold philosophy, it's the opposite. Buy and hold says, I will take all of the false negatives out there and I'm never going to do anything about it. I just want to make sure that I avoid type 1 false positives. We're the opposite. We'll take an occasional false positive in order to avoid the false negatives.
Interesting. I read a headline and I'm wondering, looking back, we talked to the main challenge with the conflict, which I believe started February 28th, was duration, as Gavin mentioned earlier. And here we are, some 6 weeks later, and we still don't know what the duration of the conflict's going to be. Yet the markets have chosen a path that they want to go. And I saw a headline that was interesting, and I know we're not managing based on headlines, but what it talked about was the markets have chosen a path, yet in reality, there's still millions of barrels of oil stuck in the Strait, and it's not all clear there yet. But the markets have chosen a path, almost as if resolution is imminent. And so I was wondering, I know that's not the false positive or false negative, but I think that goes to the point of us watching what the market does, and maybe not necessarily just a headline. So I was wondering if you had any comments kind of on those disconnects that we've been talking about, but now seeing the market really to clear path, and or maybe it's going to change directions again.
Yeah, I would just say, it depends what markets we're looking at. Commodities are elevated. The longer oil stays elevated, the higher probability that fertilizer is elevated. And the longer that happens, the higher probability that, agricultural products are more expensive. And that's, ongoing. That hasn't reversed. So, the stock market is back to all-time highs. Gavin has been doing some really good work on market structure, and we may not have time for the whole thing here, but there are structural reasons why the market, is kind of pinned or, gravitates toward, 7,000. Earnings look like they're good, so far. So, meanwhile, if you look at gold hasn't recovered. And the common thread with the Iran conflict is that the oil exporting countries that generate a surplus are not generating surpluses now. So they need dollars. If they're not getting them from selling oil, they need dollars. And, that's causing the dollar, to be firm. Otherwise would, be quite a bit lower than where it is now. The fact that trade is not generating extra reserves in their banking system means they're not going out and buying gold. And central banks have been the marginal buyer of gold for the last, 2 years. We've enjoyed the run up in gold, but until that flow starts going back in the market, gold is probably going to continue consolidating. So you get kind of different impacts depending on, what market, you're looking at. Some are clearly still impacted by it. Others, like commodities, are impacted even more. Stocks are kind of doing their own things, but there are other variables that factor into stocks, such as, the structural components that Gavin goes through every week, and, earnings, which are coming in strong.
Gavin, what are you watching this week, and what should clients be focusing on going forward?
Rich and I just had a great conversation this morning, and kind of putting it all together. The dollar did rally initially on the geopolitical stress that you would expect it to. Oil overnight, one of the first nights, was up at $120 a barrel, and that does change the macro picture if oil was to stay that high and what it does to the dollar and maybe liquidity globally. You can think through all those things. What's interesting, though, is that we are in the thick of earnings season. As Rich mentioned, earnings look pretty good. Since the conflict started, our earnings growth or earnings for the S&P, the estimates out there have been pretty strong throughout. The consensus is that, the back half of this year is going to be fairly strong. And so what we were talking about this morning, it's kind of an interesting timeline, but over the next few weeks, let's watch how guidance comes in for the S&P 500. And does that cause analysts to think that, the back half should be pretty strong? Do they need to take up their estimates? Do they need to take down estimates? So I think it's an important time as it relates specifically to the stock market, because like Rich said, like which market are we really looking at? How does guidance come in, for the back half of the year after we see, earnings coming up? Next week is a big week. Of course, we have a lot of the Mag 7, Apple and Microsoft and all those companies. I could keep going and talk about NVIDIA, which is kind of interesting right now, but I think for now, let's just see how this earnings season develops for the stock market, and that seems to kind of be center stage right now.
And I would just say, a couple of things to keep an eye on. We had the Senate confirmation hearing yesterday for Kevin Warsh. We've had this K-shaped economy for quite a while. A lot of people say since COVID, I would take it back even further, where, excuse me, the top portion of the income distribution is doing just fine. The bottom portion of the distribution has been struggling. The Fed is a major culprit in that. And based on the testimony from Kevin Warsh, it does look like, he could maybe be a bright spot at the Fed. Think about how they operate, where they think wages going up strongly is a leading indicator of inflation. It's about as backward as you could get, but that's what they do. He represents a different mindset from what's been locked in at the Fed for, 3 tenures of Fed chairs. He wants to shrink the balance sheet and he wants to lower rates. To us, that adds up to bank deregulation, which would permit banks to hold more treasuries, which could be the only way we finance the amount of treasuries that the Treasury Department has to sell without, disrupting markets. So overall, I think that's a positive development. And then, coming up in a couple of weeks, Trump is going to meet with Xi. And we've always kind of viewed what's going on in Venezuela, what's going on in Iran as, taking direct aim at China. So that could be the next set of headlines. China doesn't like the fact that we shot at a ship and boarded it and turned it around and discovered that it had materials for, that go into weapons. So longer Iran goes on, the odds go up that there's, more of a confrontation with China. And I think that meeting's coming up, mid-May, Gavin? 14th and 15th?
I think the 14th and 15th, yeah.
So by the time we get together, on the video for next month, that should be fresh news.
Well, it sounds like what I'm hearing, we're about out of our time, allotted time, but it sounds like we're trying to avoid these false negatives. The new Fed could be a positive catalyst, and like Gavin said, kind of focus on fundamentals, and they seem to be a bright spot. And fundamentals prevail many times over geopolitical risk. And I would say, compared to a month ago, it's certainly a lot more fun talking about being near all-time highs than it is correction phases that we were in. So things are moving fast, but appreciate you guys staying on top of it for our clients, and we'll talk to you next month.
All right. Thanks, Matt.
Thanks,
Bye,
Matt.
everyone.